In order to achieve the best correlation between insurance rates and actual claim costs, all insurance companies strive to match their rates as closely as possible. If insurers establish rates that are too expensive, they will lose market share to rivals who have set rates that are more precisely linked to anticipated expenses. They will lose money if they set interest rates too low. This never-ending quest for accuracy is beneficial to both customers and insurance firms. The bulk of consumers profit from the fact that they are not supporting those who are higher insurance risks than they are, people who are more likely to submit claims than they themselves are. Computerization of data has improved the accuracy, speed, and efficiency of organizations of all sizes. Credit information has been utilized in the insurance industry for decades to assist underwriters in determining whether or not to accept or reject insurance application submissions. With the advancement of information technology, insurance scores have been developed, which allow insurers to more accurately predict the likelihood of future claims being filed. An insurance score is a numerical rating assigned to a person based on his or her credit report. Actuarial studies have shown that the way a person handles his or her financial affairs, as shown by an insurance score, is a good predictor of the likelihood of filing an insurance claim. It is possible to assign an insurance score to a risk in order to assist insurers in distinguishing between lesser and greater insurance risks and charging a premium according to the risk they are accepting. People with a bad insurance score are statistically more likely to submit a claim than those with a good insurance score. Insurance scores do not contain information about race or income since insurers do not ask for this information from people who apply for insurance coverage. The poor state of the economy has had no negative impact on credit ratings. According to a press statement issued by the Property Casualty Insurers of America, PCI, in April 2009, the current economic slump did not have the detrimental impact on credit scores that some people thought it would. Major consumer credit reporting companies such as Fair Isaac and TransUnion have indicated that typical credit ratings have remained stable or have improved, potentially as a result of customers saving more and paying off their debts more often. Despite the status of the economy and the credit crisis, according to the PCI, no state has made regulatory modifications to insurers' use of insurance ratings. Activities of the federal government. A request for information from 9 of the top homes insurance firms has been issued by the Federal Trade Commission, FTC. The FTC claims that the information would help them to evaluate how credit data from consumers is utilized by the businesses in underwriting and rate setting.
The Fair and Accurate Credit Transactions Act, which was approved in 2003, required the Federal Trade Commission to engage with the Office of Fair Housing and Equal Opportunity. Whether the use of certain factors by credit scoring systems could have a disparate impact on minorities and, if so, whether the computer models used to produce comparable results could be modified to produce comparable results with a less negative impact. Credit scoring auto insurance equal opportunity. It is anticipated that the research will be completed by the end of 2010. An earlier research conducted by the Federal Trade Commission, FTC, discovered that vehicle insurers' use of insurance credit scores results in more accurate underwriting of auto insurance policies since there is a link between insurance scores and the chance of making an insurance claim. The Federal Trade Commission's study, Credit-Based Insurance Scores, Impacts on Consumers of Automobile Insurance, published in July 2007, also argues that credit scores cannot be readily utilized as a proxy for race and ethnic origin. For want of a better expression, credit scoring projected risk for members of minority groups in the same manner that it predicted risk for members of non-minority groups. The Federal Trade Commission, FTC, was mandated by the Fair and Accurate Credit Transactions Act of 2003 to investigate whether the use of credit has a discriminatory effect on the availability and cost of insurance for minority consumers. On the basis of a consumer survey, the General Accountability Office has recommended that the Treasury and the Federal Trade Commission take steps to improve consumers' understanding of credit scoring and how credit histories are used, with a particular emphasis on those with less education and less experience in obtaining credit. In addition, the Federal Reserve investigated the use of credit scoring. Despite the fact that the Federal Reserve looked at credit scores to quantify risk posed by borrowers rather than applicants for insurance or policyholders in a report released at the end of August 2007, the Federal Reserve concluded that credit scores were predictive of credit risk and were not proxies or substitutes for race, ethnicity, or gender, which corroborated the findings of the FTC study. Scores on insurance. Insurance scores are non-public assessments based on information about a person's credit history. They are a measure of a person's ability to handle his or her financial issues effectively. People who are good at managing their money are more likely to be good at managing other critical parts of their life, such as driving a vehicle safely. Insurance scores, when combined with other factors such as geographic location, previous crashes, age, and gender, allow auto insurers to price their policies more accurately, resulting in people who are less likely to file a claim paying less for their insurance than people who are more likely to file a claim. Paying less for their insurance than people who are more likely to file a claim. When it comes to homeowners insurance, insurers consider a variety of criteria in addition to credit, such as the structure of the property, its location, and its closeness to water sources for fighting fires. Insurance scores may be used to forecast the average claim behavior of a group of individuals who have roughly the same credit history as the individual. A strong score is often more than 760 points. A terrible score is one that is less than 600. People who have poor insurance ratings are more likely to submit claims. However, there are certain exceptions. Persons with excellent driving records who have never made a claim may exist within that category, just as there may be adolescent drivers who have never been in a car accident, despite the fact that teens as a group have more accidents than people of other ages. Who is interested in credit report information? In today's world, having an acceptable credit history is becoming more vital. The capacity to handle credit responsibly is equated with responsible conduct in our culture, whether we like it or not. This is true even when people have a poor credit history due to circumstances beyond their control. In order to determine if applicants handle their money properly and are thus likely to pay their rent on time, landlords often check applicants' credit histories before renting flats to them. Banks and other lenders examine loan applicants' credit histories to determine whether or not they are likely to be able to pay back their loans on time. Some companies also look at credit histories, particularly in situations where workers deal with money, and consider a solid credit history to be a sign of maturity and stability. Underwriters at certain insurance firms have historically relied on credit reports to supplement their information when extra information was required. Prior to the invention of automated scoring systems, underwriters would look at the data and make conclusions, frequently erring on the side of caution, which disadvantaged a greater number of individuals than it would have otherwise. Because automated insurance scoring and underwriting algorithms minimize the shortcomings inherent in a person's human judgment, more drivers are now placed in preferred and standard rating classes, allowing them to save money on their auto insurance premiums. In recent years, the use of credit-related information in underwriting and rating for many insurers has become commonplace, thanks to the development of these scoring models. Insurance scores are used by insurers in a variety of methods and to varying degrees of success. The majority of them are used to assess new insurance applicants and price new business. What it is and why insurers need it. When determining whether to insure a driver or a homeowner, insurers must consider the risk of loss, the possibility that the driver or homeowner will be involved in an accident and file a claim, in order to determine whether or not to insure the individual and what rate to charge for the coverage provided. It is possible for an insurance business to get closer to making proper selections the more precise the information provided. It is possible that applicants for insurance may be put in the incorrect risk categorization if their information is inadequate. In other words, some excellent drivers will pay more for coverage than they should, while other terrible drivers will pay less than they should. It seems likely that the insurance firm will collect enough premiums from both groups to cover claims and expenditures, but the good drivers will be forced to subsidize the bad drivers. Insurance companies are banned by law in every state from establishing rates that are discriminatory. The calculation of credit scores. Auto insurance is a kind of discrimination against any person. However, The underwriting and rating systems are expressly designed to distinguish between good risks and poor risks, as opposed to the reverse. Insurance is a business, and as such, insurers give preference to those applicants who are least likely to incur a loss. When it comes to the personal lines insurance sector, one of the most important competitive advantages is the ability to segment risks and price policies appropriately based on the likelihood of claims being filed against those policies. Scores on insurance policies assist insurers in achieving these goals.